Hi CA students, let's revise CFN and AFM Chapter 3 Advanced Capital Budgeting Decisions, Illustration 9. So the requirement of the question is, they've given a Excel Limited is considering its new project with the following details, like initial capital cost is 400 crores and annual unit sales is 5 crore units. Selling price per unit they've given 100 and variable cost per unit 50 rupees and fixed cost per year is 50 crores and discount rate is 6%. They are asking us to calculate the NPV of the project, which is a normal one. The next one is compute the impact on the project's NPV considering a 2.5% variance, adverse variance they are telling in each variable. Which variable is having maximum impact, that also they are asking. So this is nothing but a sensitivity analysis question. So how the project is sensitive towards the variables. So here what are they considering as variables, like initial capital cost, then units, then selling price, variable cost, fixed cost. In intermediate the same question is there, wherein they have considered discount rate as also a variable, but here they have not considered it. I have calculated for discount rate also. So let's dive into the question. The first part of calculating NPV is simple. We'll take the selling price minus variable cost, then we'll have a contribution of 50 rupees per unit, which will multiply with the number of units sold per year, which is 5 crore units. Then we are getting a contribution of 250 crores and fixed cost is 50 crores. So net cash inflow per year, so they've given useful life for 3 years, so per year net cash inflow 200 crores. Then they've given a discount rate of 6%. After considering for 3 years, discounted with per year, here the cash inflows are same. We can go with annuity factor also. Still, so we got a net present value of 134.6, which is a positive NPV. On the face we can accept the project. Now we are going with the sensitivity in each variable. They told us to take 2.5% as adverse variance. Adverse in the sense in the negative effect. Going with the sensitivity analysis, first base the same whatever we did for the first requirement, same we can keep as the base, and the NPV is 134. Then we'll keep the other things constant and change the variable. So as the first variable they've taken initial cash inflow, which is 410 crores. Actually it is 400 crores plus 10%, 410 they've considered. After considering keeping the other things remaining and initial inflow of 410, we got an NPV of 124.6. Since in adverse variances all your NPV should be less than whatever is calculated as the base, right? Because in the worst situation my NPV will reduce, it will not increase. If in your answer if it is increasing, then you are going somewhere wrong. That you can keep as a cross check. So in the first case, as the initial investment increase, my NPV also reduced from 134 to 124. The difference of reduction is 7.43%, keeping 134 as the base. Now going up next, selling price. So if selling price should reduce ideally, that is the adverse variance. 10% if I 2.5% if I reduce, then my selling price per unit will become 97.5. Here you should not consider selling price because the variables which they have given are per unit. So we should also take per unit and then do the sum. Then 97.5, then considering that selling price as the adverse one, we are getting an NPV of 101, which is again a reduction from 134. The reduction is 24.82%. Coming up next, variable cost. So ideally cost should increase, which is the adverse position. So 100 is my selling price per unit, and then variable cost, previously it was 50, now 51.2, and we are getting a contribution of 48.75. Then the NPV is 117. There is a reduction of 12%. Going up next, fixed cost will ideally increase in the adverse situations. So fixed cost has increased 51.25. Then we are getting a NPV of 131.26. The reduction in percentages, NPV percentage is 2.48. The next one is unit sold, because they have given annual unit sales, which is also a variable. So 5 crore units. At the adverse situations, we will sell less units. So 5 crore, that 2.5 percentage, if I reduce, it will become 4.875 crores. Then multiplying with the contribution, we'll get a 243.75, and coming up to my NPV, it will become 117.89. So the reduction in NPV percentage is 12.41. As I've told, in intermediate, one of the RTP or MTP, I'm not sure about it, they've considered discount rate as an variable. So same thing I've done here, 6% plus 10%. Okay, sorry, here ideally we should take 2.5 percentage. I've taken 10 percentage. Sorry for that. You can just add 2.5 percentage to this. That will be an adverse situation. Then getting an NPV of 128. As NPV is less than that, then I have considered 10 percentage. I'm getting a negative 4.36 percentage as a reduction. Now don't consider this part. You have to take 2.5 percentage as the variance, adverse variance. Okay, even though if we are not considering this as solved by ICAI, the worst situation is this selling price per unit. If the selling price per unit has an adverse effect of 2.5 percentage, it will reduce our NPV up to 25 percentage. So that's what they have asked, which variable is having maximum effect. So selling price per unit has the maximum effect. The change in selling price has the maximum effect on the NPV by 24.82 percentage. Thank you.